But now you're like, Ivy, which stocks should I buy? Number one, I would recommend that you buy shares for the first time from the banking industry. Go buy shares in any bank. Buy at Stanchart, Corp, KCB, Equity, NCBA. Buy from any bank. Just have a bank in your portfolio. Portfolio is like a basket of stocks that you want to buy, because you don't want to buy stocks in one sector. You don't want to buy stocks at use your 50,000 or use your 10,000 or even your 3,000 shillings to buy stocks from one industry. Buy from different industries, but just make sure you have a stock in the banking industry, because banks are profitable, banks are more stable, like banks have to make profits. The other thing that you need to consider when you're buying stocks is look at volume. I'm emphasizing this. If you're going to buy a stock that you intend to sell quickly, like you want to be a trader, you buy stocks, you sell stocks. So for you, your main source of income is going to be in terms of buying and selling, buying and selling. You want to buy stocks that have a high volume. Stocks that have a high volume mean that you can sell them off in case you want to take advantage of the capital gain. Examples of stocks that have good capital, or rather examples of stocks that have a high volume, we have KPLC, we have Kengen, we have Safaricom, like 2 million or even 20 million shares can be traded in a day. That's a good stock. But if you go for companies whose stocks, or rather the volume is like 100, 400, assuming that you bought 20,000 stocks there, and when you check in the Nairobi Securities Exchange market, you can only see that only 400 are being traded. There's no way you're going to dispose of your stocks. The other important thing is that buying stocks from a high volume stock is going to help you in case you buy stocks and later on you're like, I don't want to invest in stocks anymore. You can always sell your stocks and you can always get back your money. But if you buy stocks from a company whose volume is less, you're going to remain with your stocks, because it's not an active stock. It's mainly for dividend payouts. You're going to notice that with a company, an example like Williamson Tea, it doesn't trade that much, but it pays out a good dividend. So that's like a dividend paying stock. You have to find a balance: dividend paying stocks or capital gain stocks. Another example is a company like Uchumi, and there's another one called TransCentury Limited. These two companies don't pay out stocks, or rather they don't pay out dividends, but they are good in terms of taking advantage of the capital gain. Like Uchumi went down, but the stocks are still being actively traded in the Nairobi Securities Exchange market because people are buying and selling, in as much as it doesn't pay out any dividends. TCL has never paid out dividends. The price is in cents. Literally, you'll find that one stock is around 0.44 cents. Initially, you as a beginner, you might be tempted to go there, but this stock doesn't pay out any dividends. It doesn't pay out any dividends. And since you're new to this, you're expecting dividends to be paid out. You're going to be, oh my goodness, this one is so cheap. Let me buy so many shares, but they don't pay out any dividends. So if you are you're looking for a dividend paying stock, you need to take note of those two companies. The other tip that I would share is that start small. Don't give yourself pressure to invest 50,000 Kenyan shillings and you don't even have a good understanding of how the market works. Start with 3,000 this month, go to 3,000 next month. The next month, use your 3K to invest in stocks. Like, keep on building upon your investments. Don't give yourself pressure to spend 30,000 on stocks or on shares. Start small, have experience for a whole year or even 6 months, whichever is going to take you to learn, whichever amount of time it's going to take you to learn. But start small, such that if you go for a whole 6 months and you realize this is not something that I want, and you only did an investment of 5,000 shillings, of 10,000 shillings, you can always easily opt out and go for other investments, other than you putting in your 100K with expectation that you're going to make a lot. So just start small, get to learn some tricks, try buying, try selling. Yeah, try even selling your stocks and see how it works, so that you're able to learn from the mistakes that you might want to make when you have invested less, and avoid those mistakes, those tiny mistakes, when you invest 500K, when you invest 200K, when you invest 100K. In terms of risks in investing in stocks, there are a number, just a few of them. One is that shares are very volatile. Volatile means the price can go up, the price can go down, the price can go up, the price can go down. Investing in shares is not a lazy investment. It's not like investing in a money market fund, you're just seated there. Or in a bond, you're done, you're just expecting your returns. You have to be active. You have to check how the market is performing such that if the price goes up quickly, you can sell your shares. If the price goes down, you hold your shares. It's an active investment that is not for the lazy. You might lose your money. You might lose your money if you invest in a company and the company fails. I'll give an example. You know of Uchumi, you know of KQ. What happened to KQ? KQ doesn't make any profits. It's suffering a loss. So whoever invested then when the value of the share was up has lost now that the value of the share is down. We had billionaires. We had, what's this guy? Chris Kirubi, the late Chris Kirubi. He invested millions there. He bought millions there with the speculation that the company would recover, but it did not. So the guys who invested then lost, although the company is still trading their shares. That's one risk. The company might fall out in terms of this mismanagement of funds, like what happened to Uchumi in terms of just things affecting the sector and affecting the whole business, such that the business is not profitable anymore and the value of the share goes down. Assuming that you bought shares when the value of the share was like 20 shillings and now it's 6 shillings, 6 years later, you've lost, assuming that you didn't sell your shares then. That is one of the risks. That's why you must look at the company that you're investing in, the sector that you are investing in. You must keep yourself updated with what is currently happening. What are some of the trends that are affecting the technological industry? Do you see the technological or the communication sector growing? I'll give an example. Nation Media. It's a communication industry, but now there's this change of not everybody is into the newspapers or the TV. You might look at it this way. 5 years down the line, the sector won't be robust. The sector won't be as promising as it is now. So those are some of the things that you need to know. You need to look at the sector that you're investing in. What are some of the regulations that are being passed because they might affect your industry negatively, or they might affect your industry positively. Are there any new taxes that are going to be introduced here? How are they going to affect the profits of these companies? Remember, dividends are paid out from the profits that the company makes. Those are some of the few things. Investing in stocks is not a lazy investment. The downside to investing in stocks is that dividends are not a must. Not all companies pay out dividends. You remember Uchumi? Uchumi doesn't pay out dividends. KQ doesn't pay out dividends. TCL has never paid out dividends. And even the companies that pay out dividends don't pay out consistently. Okay, for some it's consistent, for some it's not. I'll give an example like KPLC. For the past years, they've not been paying out dividends, but they paid out in 2024. Kengen, same case. They've had like a dividend payout drought where they were not paying out the investors. So if you are investing here, you have to know that not all companies pay out dividends. And even the companies that pay out dividends don't pay out pay out twice a year. Because for you, you might want to invest in a stock that pays out dividends twice a year. Well, not all of them pay out their dividends twice a year. Some pay out once a year, some pay out twice a year, and some might pay out this year and not pay out next year. That's one of the downsides. But at least you can take advantage if you are able to buy in stocks that are more of capital gains, the stocks that have a higher volume, the ones that you can easily dispose in case you feel like you want to take advantage of the price going up, or you want to not just invest in shares, you want to dispose everything and get your money back. Just one last thing, don't put your emergency money in shares. Don't put your emergency money in shares. You're going to lose because it depends on how the market is. If you want money for emergency, put it in a money market fund. But if you want long-term investment, you are thinking of 3 years, 4 years, 2 years down the line, then invest in stocks. Take it slow, start small, grow your portfolio, invest in different companies in different sectors, give them a try, see how they work, buy, sell shares. Happy investment journey.